In its last meeting in November last year, Central Bank's Monetary Policy Committee decided to retain the central bank rate of 10% for the 10th consecutive time, citing favorable weather conditions, low inflation and sustained macroeconomic stability. Today's meeting, scheduled for this afternoon, comes against the backdrop of sustained sentiment by experts that Kenya's decision to peg the interest rate cap on its base lending rate has eroded the decision-making and monetary policy transmission capacity at the CBK. Key concerns, according to analysts at Cytonn Investments, is the declined economic growth that came in at 4.4% in the third quarter of last year, as well as the slowed private sector credit growth at 2%, well below the government-set annual target of 18.3%. This trend, according to experts, may adversely impact on economic growth, which will be a key driver in future monetary policy decisions. However, with inflation having eased to 4.5% from 5.7% since the last meeting and the currency having appreciated by 0.5% over the same period, the analysts believe that MPC should adopt a wait-and-see approach by leaving the rate unchanged at 10%, given the macroeconomic environment is relatively steady. The rising cost of fuel in the world market, however, continues to be a topic of concern, though it is widely expected that the international oil prices will oscillate within a range of $60 to $70 per barrel this year. As such, Cytonn expects inflation rate to increase marginally in January from December due to rising food and fuel prices, but remain within the government target range and average at 6.6% in 2018. The central bank uses the CBR to guide on lending rates for commercial banks, which are currently pegged at 4 percentage points above the benchmark rate.